Hi, I'm Andrew Glaze, CEO and founder of WealthStack, and man, oh man, do I have a special treat for you in this video. Be sure to watch until the end. So, we're here to talk about what's going on in America's economy, what's going on in the marketplace, and it is getting crazy out there. First Republic Bank was as high as 220 in November of 2021, and now is at $12. That is a massive decline in value. And so this is indicative of the times that we live in. We had Credit Suisse acquired by UBS overnight. This is creating, I think, increasingly challenging backdrops for entrepreneurs to get access to capital. Thankfully, at WealthStack, we've got tons of connections and are still being able to put deals together for our clients. But let's take a deeper look at what's going on here and let's talk about some exciting opportunities that we see here. And so Silicon Valley Bank gone, a number of regional and community banks are being taken over by the Fed. There's a crisis of confidence. Now, as a hedge fund investor, we're taught to always look for opportunities to create value, especially in times of turmoil. And so, in taking a look at what's going on with the options for First Republic, I see some really interesting opportunities here. So let's take a look. Again, this stock was at 200 not too long ago. Now we're at 12. There are calls available for the furthest out range, Jan 2024. And let's look at the 30s. Those are available right now for $3. Implied vol of 150. Now that may seem high, but I actually think it's relatively low given everything that's happening with this business. Now, I certainly am not going to suggest that you take a flyer that things are going to be okay at First Republic. Given the recent history of banks going to zero, there's real risk that this could go to zero too, in which case these options would go to zero. But there is the potential to combine a put with a call to create a straddle, an option strategy involving the purchase of both puts and calls. And doing so here, I believe, creates asymmetric returns. Now, asymmetric returns are the primary objective of most hedge fund investors. I found one here for you, and I wanted to share it because I love hooking up my community. Now, asymmetric returns means that the sum results that are positive and in your favor far outweigh those that are negative. And so, in taking a look at this, I said, you know what? This either goes to zero or things are going a whole lot higher than they are now. And there's a binary outcome. And I think we end up seeing that over the next few months. And so there's a potential to buy puts, which January 2024, 250s are trading at 50 cents. I might bring them in a little bit closer. Maybe look at maybe the Octobers, maybe even the summers, maybe September. But looking at end of year, this means if it does go to zero, you'll 5x your money on the put side. Looking at these, and let's say it went to, let's say 60, and you bought at 3 with a strike of 30. If you're at 60 this time next year, you'll have made 30, so that's 10x. 10x on the upside, 5x going to zero. And so you're going to want to combine these for the optimal. Now, for those that share this video and comment below, I'm going to be hooking you up with a special spreadsheet that I first used actually in Baghdad in 2004 to calculate a straddle of some Google call put options ahead of earnings. Now, this is what we call a vintage classic, and I will be walking you through step by step how you can put together this template. I'll be providing the template, and I'll also be giving you the detailed analysis. Now, if you're able to zoom in here a little bit and see, what you'll see is that we've got a range of different scenarios and the payout available for each one. Now, again, with puts and calls, you can get asymmetric outcomes, meaning that you can put $2,000 down worth of calls, and in the rare but possible outcome where this stock is rising to 50, $60 or higher, get a massive reward on that side. When you combine that by owning puts that pay you as the stock goes down, you can create a range of outcomes where you're able to get a favorable return, again, asymmetric returns. How can you lose? You can lose in the middle. And so if the stock doesn't go to zero and languishes around 12 and stays there at the time between now and the expiration date, then you could lose everything that you risk in principal. And so it's really important not to risk more than you can lose. But that doesn't seem likely here that this will hang out at 12, not with this dramatic of a fall. The odds are pretty good. It does go to zero, but if they figure it out, it's going to be looking pretty good for them. I got to imagine. And again, that creates a great asymmetric risk reward. I'm Andrew Glaze, CEO and founder of WealthStack, and we're here to help.